Have you ever noticed how the financial media seems perpetually surprised by market movements? One day they're celebrating record highs, and the next, they're predicting economic collapse. It's as if the markets operate in completely random, unpredictable ways. But what if I told you that markets aren't random at all? That beneath the apparent chaos lies a rhythm and pattern that repeats with remarkable consistency. Today, we're diving into one of the most powerful concepts that separate successful traders from the masses: market cycles. Understanding these cycles isn't just academic knowledge. It's the framework that can transform how you view the markets, position your capital, and ultimately create the kind of consistent results that lead to true financial freedom. Let's start with a fundamental truth. Markets don't move in straight lines. They breathe. They expand and contract. They go through predictable phases that have repeated throughout history. Yet most retail traders and investors completely miss these patterns, instead getting caught up in the day-to-day noise and emotion that dominate financial headlines. Think about it. How many people do you know who bought crypto at the top of 2021 only to sell in panic at the bottom of 2022? Or loaded up on tech stocks in early 2021, then abandoned their positions after the brutal correction in 2022? This isn't random bad luck. It's what happens when you don't understand market cycles. So what exactly are market cycles? At their most basic level, market cycles are recurring patterns of expansion and contraction that occur across all financial markets: stocks, real estate, commodities, crypto, you name it. These cycles don't follow exact timelines, but they do follow a predictable sequence: accumulation, markup, distribution, and markdown. The accumulation phase happens after a prolonged decline when prices have stabilized. This is where smart money, institutional investors, funds, and professional traders begins to accumulate positions. The general public isn't interested at this point. The media is still negative. Most retail investors are either licking their wounds from the previous decline or waiting for confirmation that the market is safe again. Then comes the markup phase. This is where prices begin to rise steadily as more participants recognize the uptrend. Early in this phase, you'll see improving fundamentals, increasing volume, and technical breakouts. As the markup phase matures, you'll notice increased media coverage, growing retail participation, and a shift from skepticism to optimism. Next is the distribution phase, the period where smart money begins to sell their positions to eager retail buyers. This phase is characterized by high optimism, sometimes even euphoria. You'll hear phrases like "this time is different" or "new paradigm." Price increases may become more volatile, with sharp rallies followed by concerning drops. Volume often reaches its highest levels during this phase. Finally, we reach the markdown phase, the painful period where prices decline, sometimes dramatically. Early in this phase, many still believe it's just a healthy correction. As the decline continues, sentiment shifts from concern to fear and eventually to despair. Volume may spike during panic selling events, but generally decreases as the phase matures. By the end, most retail participants have either sold at a loss or sworn off the market entirely, right as smart money begins accumulating again, restarting the cycle. Now, these phases aren't just theoretical concepts. They play out in real markets with real money at stake. Let's look at some historical examples to cement your understanding. Consider the crypto market from 2018 to 2022. After the 2017 bubble burst, Bitcoin entered an accumulation phase throughout much of 2019 and early 2020, trading roughly between $3,000 and $10,000. Few people were interested. The media had largely written off crypto as a failed experiment, but institutional investors were quietly accumulating. Then came the markup phase from late 2020 through 2021, as Bitcoin surged from around $10,000 to nearly $69,000. Early adopters who understood the cycle were richly rewarded. As the price rose, media attention increased, public interest surged, and new retail investors poured in. By November 2021, we had entered the distribution phase. You saw celebrities promoting obscure cryptocurrencies. Taxi drivers and barbers were giving crypto tips. NFTs of cartoon apes were selling for millions. The euphoria was palpable, and it was precisely when smart money began to exit. Then the markdown phase arrived with brutal efficiency throughout 2022, as Bitcoin fell over 70% from its highs and many altcoins dropped 90% or more. Those who understood market cycles had either taken profits or maintained strict risk management. Those who didn't were left holding rapidly devaluing assets, wondering what happened to their guaranteed gains. This pattern doesn't just apply to crypto, it's visible across all markets. Look at the dot-com bubble of the late 1990s, the housing market in the 2000s, or even single stocks like Tesla. The cycle repeats with remarkable consistency, though the timeframes and specific details vary. But understanding the broad pattern is just the beginning. To truly leverage this knowledge, you need to recognize the signals that indicate transitions between phases. These signals come in three main categories: economic indicators, sentiment indicators, and technical indicators. Let's start with economic indicators. These are the fundamental factors that impact asset values. Things like interest rates, inflation, GDP growth, unemployment, and corporate earnings. In the early accumulation phase, these indicators often look terrible, but they are actually beginning to improve from even worse conditions. By the markup phase, they're clearly improving. During distribution, they're typically strong but beginning to show cracks. And in markdown, they deteriorate, sometimes rapidly. Interest rates deserve special attention here, as they're one of the most influential factors in market cycles. When central banks lower rates, they effectively make money cheaper and encourage risk-taking. This often coincides with the later accumulation and early markup phases. When they raise rates to combat inflation, they're making money more expensive, which eventually pressures asset valuations, often during the distribution and markdown phases. Next are sentiment indicators, measures of how market participants feel. These include surveys like the AAII Bull-Bear Ratio, the VIX Fear Index, put-call ratios, and even cover stories in major publications. Sentiment is a powerful contrarian indicator, meaning extreme readings often signal potential reversals. When everyone is pessimistic, we're often near the end of a markdown phase. When euphoria reigns, we're typically in the distribution phase, nearing a top. Finally, there are technical indicators, patterns visible in price and volume data. These include trend analysis, moving averages, relative strength comparisons, volume patterns, and breadth indicators that measure market participation. During accumulation, you'll often see declining volatility, higher lows, and increasing buying pressure. Markup phases show strong uptrends, with pullbacks finding support at rising moving averages. Distribution phases often feature increasing volatility, failed breakouts, bearish divergences, and deteriorating breadth. Markdown phases show decisive trend breaks, declining moving averages, and eventually, capitulation volume. No single indicator is perfect, which is why successful traders use a combination of economic sentiment and technical signals to identify where we are in the cycle. It's about weight of evidence rather than looking for the one perfect signal. Now let's talk about how to position yourself for different market cycles, because understanding the pattern is only valuable if you can translate it into effective action. During accumulation phases, the strategy is relatively straightforward. Begin building positions in quality assets that have been oversold. This requires courage, as the prevailing sentiment will still be negative. You're not trying to catch the exact bottom. Rather, you're looking for assets with strong fundamentals that have been beaten down by market psychology rather than actual deterioration in their value proposition. For the markup phase, the key is to ride the trend while managing risk. This means establishing trailing stops that lock in profits while allowing winners to run. It also means being selective. Not everything rises equally during bull markets. Focus on sectors and assets showing relative strength compared to the broader market. The distribution phase requires increasing caution. This is where greed can cloud judgment. As your positions show substantial gains, it's tempting to imagine even more upside. The key here is to begin taking partial profits, tightening stop losses, and becoming more selective about new positions. Don't try to sell the exact top. Instead, focus on preserving the gains you've accumulated during the markup phase. During the markdown phase, capital preservation becomes primary. For most traders, reducing exposure and raising cash is the prudent approach. For those with the skills and experience, selective short positions or hedging strategies can be profitable. Remember that markdown phases often end with capitulation, a dramatic sell-off on high volume that marks the transition back to accumulation. This cyclical approach to markets contradicts how most people invest. The typical retail investor does exactly the opposite of what they should. They're fearful during accumulation, hesitant in the early markup phase, fully invested during distribution, and panic selling during markdown. They buy high and sell low, then wonder why they can't seem to make money in the markets. By understanding market cycles, you position yourself alongside smart money rather than against it. You begin to see opportunity when others see danger, and danger when others see only opportunity. This perspective shift alone can transform your results. But there's an important caveat here. Market cycles don't follow exact timelines. They're influenced by countless variables, from government policy to technological innovation to global events. The challenge isn't in understanding the pattern. It's in correctly identifying where we are in real time without the benefit of hindsight. This is where humility and risk management become essential. Even the most experienced traders and investors get it wrong sometimes. The difference is they don't bet everything on being right about the cycle. They manage position sizes, maintain stop losses, and diversify across assets and strategies. They understand that being approximately right is more profitable than being exactly wrong. There's also the question of time frame. Markets have cycles within cycles. Long-term secular trends that last decades, intermediate trends that last years, and short-term cycles that play out over months or even weeks. The key is aligning your trading or investing approach with the cycles that match your time frame. Day traders focus on intraday cycles, swing traders on intermediate moves, and investors on the larger secular trends. For most people reading this, focusing on the intermediate and long-term cycles will yield the best results. These are easier to identify with greater confidence, and they allow you to position yourself for substantial moves without getting caught up in short-term noise. So how do you apply this knowledge today? Start by honestly assessing where we are in the current market cycle. Look at the economic indicators, interest rates, inflation, earnings trends. Evaluate sentiment. Are investors broadly optimistic or pessimistic? Examine technical patterns. What are price trends, breadth indicators, and volume telling you? Based on this assessment, adjust your positioning accordingly. If we're in accumulation, build positions methodically in quality assets showing signs of bottoming. If we're in markup, maintain exposure while managing risk with trailing stops. If we're in distribution, take partial profits and tighten risk controls. If we're in markdown, focus on capital preservation. Remember that different sectors and asset classes can be in different phases simultaneously. While the broad market might be in one phase, specific sectors or individual assets might be in another. This creates opportunities for rotation strategies, moving capital from assets in later cycle phases to those in earlier phases. The beauty of understanding market cycles is that it frees you from the emotional roller coaster that destroys most trading accounts. Instead of reacting to daily headlines and price movements, you're operating from a strategic framework that puts those movements in context. You're playing chess while others are playing checkers. This perspective shift doesn't just improve your financial results, it transforms your relationship with the markets. The anxiety that plagues most traders during volatile periods diminishes when you understand that volatility is simply part of a larger pattern. The FOMO that drives impulsive decisions fades when you recognize that there will always be another opportunity in the next cycle. In essence, market cycles are the rhythm of opportunity. By understanding and aligning yourself with these cycles rather than fighting against them, you position yourself for the kind of consistent success that builds wealth over time. You stop hoping for luck and start creating your own edge. The markets will always have their ups and downs, that's their nature. But with the framework we've discussed today, those ups and downs become predictable patterns of opportunity rather than random events that happen to you. And that shift in perspective makes all the difference between the masses who lose money in the markets and the select few who consistently profit from them. If you're ready to dive deeper into market cycles and build a systematic approach to trading based on these patterns, I encourage you to join our Discord community. We regularly analyze current market conditions through this cyclical lens and help each other identify opportunities across different asset classes. The link is in the description. I look forward to seeing you there and helping you navigate these cycles with confidence.